Hey everybody, thank you so much for checking the channel out today. My name is Agabus. Let's get into it. China's debt outlook downgraded as the economy is starting to slow. If you haven't been paying attention to the debt market globally, which is larger than the stock market, you're missing the boat on a lot. Let's take a look over here at China. We're at the BBC. The risk from China's debt pile are mounting as the country grapples with an economic slowdown and property crisis, leading credit ratings agencies to downgrade them to negative. Moody's just issued it the other week. The government's debt to negative from stable. The firm is the latest to raise concerns about problems facing the world's second largest economy. Of course, China is disappointed by the move, calling the economy resilient, but the country has signaled plans to ramp up stimulus spending as it battles soaring youth unemployment. Fun fact, they stopped reporting on youth unemployment because it was so bad. Weaker global demand hitting its manufacturing industry and deepening woes in the property sector. The manufacturing industry, some would say, is getting hit because the U.S. is getting hit. And if the U.S. isn't spending to buy China's stuff, then they're just not going to be making it as much as they used to. Also, some of the country's largest construction companies are facing insolvency and have stopped building, leaving customers stranded, even though they've already bought the property. Moody's said the expected support for the local governments and other state-owned enterprises presented broad downside risks to China's fiscal, economic, and institutional strength. The negative outlook is a sign that Moody's could downgrade China's credit rating, which is used by investors to help assess risks associated with investing in bonds or other debt, and helps inform how lenders should be setting their interest rates. The U.S. recently had their national debt get downgraded. Aside, El Salvador had their national debt get upgraded. Wonder why? Of course, China's finance ministry said the country's long-term prospects had not changed and expected to be able to manage the impact of the property sector slowdown, which is significantly large in the country. It's over 30% of the general market. They continue and said China's macroeconomic economy continues to recover and high-quality development is steadily advancing. It's unnecessary for Moody's to worry about China's economic growth prospects and fiscal sustainability. However, after decades of seeing its economy expand by more than 8% a year, China is now on track to grow by as little as 5.4%. However, growth is likely to slow to 3.5% in the next couple of years, according to the International Monetary Fund. Over here at CNBC, China's big property market problem is going to take 4 to 6 years to resolve. It sounds like a much bigger problem than what the other article is saying. Looking at nationwide data, whether based on official estimates of unsold inventory or the construction to sales ratio, Liu had found it will take at least 4 to 6 years for real estate developers in China to complete unfinished residential properties. That means efforts to boost funding to developers and other efforts to resolve China's property market problems don't directly address the bigger issue of uncompleted homes. Increase in supply coming from secondary market transactions as households worried about depleting profits from price declines sell their second or third homes is an additional drag to the process, she said, noting that developers' inventory is far too large for households to absorb so quickly. Apartment homes are typically sold ahead of completion in China, making it critical that developers finish constructing the houses if they are to sell more. On the extreme end, residential construction in some provinces could take over 20 years to complete. Hopefully, will more than likely take only 10 in some smaller provinces. That would be nuts if new homes don't get resolved for 20 years. Here we go. Real estate and related sectors have accounted for about 1/5 to 1/4 of China's economy. Going a little bit deeper into the debt world, China's junk bonds remain a landmine as developers, not out of the woods yet, and defaults to persist. We're over here at wolfstreet.com to look at the credit rating of a bond. The value of the bond is not only based on the maturity or the duration, but based upon the paying ability of the company or country issuing the debt. You can see here that quote-unquote investment grade is in the top section here, and once you get below triple Bs, that is considered junk grade. Junk bonds were big in the 80s. Junk bonds don't sound very good anymore, so people sometimes refer to them as high yield bonds because they have to pay out a higher yield in order for investors to take on the additional risk of the junk. Dollar-denominated bonds sold by junk-rated Chinese developers remain a minefield for investors as another depressing year of losses and defaults in the real estate sector draws to a close, according to money managers. China's property sector is not out of the woods yet, said Andy, co-head of Asia ex-Japan Fixed Income at Pine Bridge Investments, managing $155 billion worldwide. He said, "We don't have high confidence in the sector, and we're still very cautious." China's US dollar denominated high yield, there's that term, or junk bonds denominated by property debt have lost 22% so far this year, and that's after a 33% drop in each of the past 2 years. Now, when someone's investing in a portfolio, they may have stocks and bonds because they work opposite of each other. Bonds usually, historically, are the more conservative side of the portfolio. However, if you have bonds that are dropping 22 or 33% year over year, I don't know if that's very conservative anymore. Country Garden, once considered a financially healthy private developer, found itself mired in crisis this summer and went on to miss a coupon payment of $60 million in October. China Evergrande Group, meanwhile, awaits another hearing next month as its insolvency process continues. The article continues and says, "We have seen the biggest wave of defaults already, and for survivors, we expect further defaults to continue." Goldman Sachs says the default rate for high-yield property bonds, or junk bonds, will remain elevated next year as well as home sales continue their slide, putting more strain on an already stretched liquidity conditions, again, according to Goldman Sachs. Here at Wikipedia, you can see the world bond market by country. It's the U.S. number 1, and number 2 is China. If that debt market starts to flounder and go down, I would argue or bet there's probably going to be a domino effect in the rest of the bond market. Just my 2 cents, some random guy on the internet, but let me know your thoughts as you're viewing the markets, the interest rates, recession, etc. Would love to know your 2 cents. Thank you so much, as always, for listening to the end. Stay inquisitive, stay informed, and stay subscribed for more. We'll see you tomorrow.